Hello everybody, I am Jim Farron. Before we get started today, let's talk about you for a minute. Since we are having this conversation, I can guess that you are interested in learning more about how to invest for income in retirement. And I know that some of you will want to watch this whole video. It's 30 minutes, and I know that is kind of a lot of time. But that's because we put a lot into it. We examine one famous millionaire's tax return. We explore the 7 strategies that we use with our clients to generate retirement income. I think it's well worth anyone's time. But we also know that some of you will not want to take the time for it all, at least maybe not right now. But you still know that investing for your retirement future is important to you. So there's a link below that you can click on to schedule a strategy session telephone call with me. Click on it now, or click on it later. These telephone appointments take about 20 to 30 minutes. They are strategy sessions. We'll talk about you and your situation, your needs, and what you want. You can do this from the comfort of your own home with no cost or obligation. It is our chance to get to know you and how we can help you. And it is your chance to check us out, to get to know us in a very easy way. So let's get started. I hope you'll stay with us. But if not, I hope you'll click on the link below to schedule a time that you and I can visit about your needs. My name is Jim Farron. I am a certified financial planner. I'm a 1981 graduate of BYU, and I started this company almost 25 years ago in 1993. We are retirement income planning specialists. There's a huge question that nearly everyone ultimately faces, which is, with bank interest rates still hovering around 1 or 2%, how in the world can you generate enough retirement income from your retirement savings? We counsel all the time with people who have done a good job of saving for retirement, of investing for growth in their 401ks or IRAs. But as they approach actual retirement, the question looms large. How can I now invest for income, enough income, and be smart about doing it? Because nobody wants to run out of money during retirement. And nobody wants to risk losing it all either. And locking it up in an annuity for the rest of your life isn't very attractive. Wouldn't you think that there are responsible strategies that smart retirees can use to produce real cash income from their investments? The answer, of course, is yes. Absolutely yes. And you'll see, all investments are not created equal. Some investment strategies are way better suited than others to generating cash income. And today, we're going to explore 7 of them. Which brings us to the lessons we can learn from the very wealthy, the super rich. Do you ever wonder how they invest? Do you think there might be something we can learn from them? In the next 30 minutes, we're going to explore how wealthy people invest for income. In fact, we're going to really examine 7 different strategies for generating recurring investment income. We're going to look at specific examples, including a hypothetical example of a couple with over $100,000 of income but pay no federal income tax. We're going to examine one famous millionaire's tax return. We're going to talk about how income taxes impact different investments. And we're going to invite you to join with me on a strategy session telephone call so we can discuss your needs and how these strategies might work for you. So I invite you to stay with me on this and check this out. Let me tell you about the very rich. They're very different from you and me. So wrote the American author F. Scott Fitzgerald in 1925, to which Ernest Hemingway is said to have retorted, "Yes, they have more money." Well, they might not be so different from you and me, but Hemingway is right, they do have more money. So let's see what we can learn from some of them. Let's look at one famous millionaire's tax return. You might be surprised at what we learn from it about taxes and about investing for retirement income. So do you remember back in 2012 when Mitt Romney was running for president? He was criticized that he paid income taxes at a lower rate than Warren Buffett's secretary. Not that he paid less tax than her, but that his tax was a smaller percentage of his total income than hers was. Was that true? Well, back during the campaign, he released his tax return to the public. It's now public information, and there's some great lessons for us to learn. and not just about taxes, but about retirement income. Let's take a look. The first thing to notice is that Mitt received no wages or salary in 2011. I guess we might say that Mitt was retired. But he did have income, lots of income. He had retirement income. Mitt's total income in 2011 was $13.7 million, and his total federal income tax was $1.9 million. So, Mitt's federal tax bill for 2011 was just over 14% of his total income. So it was true. Well, how did he do that? Let's look a little closer. Mitt had over $3 million in taxable interest. Most of this came from government bonds. In 2011, U.S. government bond rates were about 4.1%. This suggests that Mitt had a little over $71 million in U.S. government bonds. Today, those rates are more like 2.7%. You can still make $3 million per year in government bond interest, but you'd need over $100 million in government bonds to do it. So if you have, say, $100,000 in government bonds, you might expect about $2,700 per year of interest income. Mitt also received dividends of $3.6 million in 2011. But notice that $2.2 million of that amount, or more than 60% of his dividends, are considered qualified dividends. What are dividends? And what are qualified dividends? Well, those are some of our retirement income strategies. Mitt certainly used them to his advantage, and so can you. But know this right now. Qualified dividends are taxed at a much lower rate than bank interest, government bond interest, or salaries. And we'll explore all of that in a minute. But let's leave the billionaires behind for just a moment and talk about the real challenge facing today's normal retirees. Glassdoor.com reported that Starbucks baristas make, on average, about $9.43 per hour, or about $20,000 per year, including tips and bonuses. So what's that got to do with you and your retirement? The answer is bank interest rates. You probably remember when rates were 5%, 6%, or even more. But not today. Zions Bank publishes their 5-year certificate of deposit rate of 1.01% per year. And Bankrate.com reports nationally the highest 5-year CD rates to be 2.5% per year. So think of it. If you are a millionaire, if you have $1 million in the bank, you make about as much income as a Starbucks barista. Let that sink in for a moment. Now, I mean them no disrespect, but I suspect that isn't your idea of $1 million retirement. So how did this happen? The answer is that it has been a deliberate policy decision of the Federal Reserve. 10 years ago, the Fed started a zero interest rate policy. They pushed their benchmark interest rate literally down to zero, and bank interest rates followed suit. Now, for at least 3 years, they have wanted to push rates back up. But not wanting to hurt the economy, they have been very slow to do it, raising it at about 0.25% each time. In December, they pushed the benchmark target rate to 1.25%, and going forward, they will no doubt push it higher still. So, zero interest is over, but low interest remains. Let's not hold our breath for 5% or 6% bank CDs anytime soon. For the foreseeable future, we should expect a continued low interest rate policy from the Fed. Of course, you already knew that you can't live on Starbucks wages, and you also know that you can't live on bank interest either. Still, keeping some money in the bank is still a good idea. But here's the very scary thing that retirees with money in the bank do. They spend their interest and their principal. We call that eating your seed corn. It is a sure path to running out of money one day. But the good news is this doesn't have to be you, because there really is a better way. Let's explore it. Thankfully, you don't have to be a billionaire to do this, but you do have to have a large enough portfolio to allow for proper diversification. Those who have saved at least $250,000 for their retirement will benefit most. And to understand these strategies for what they are, we have to first understand what they are not. What we're not talking about is this idea of just taking a systematic monthly withdrawal from a diversified portfolio of stocks or mutual funds by actually selling a few of your shares every month or every year. The trouble is, once those shares are sold and spent, they're gone and they're never coming back. Just like spending down your principal in the bank, I call this eating your seed corn too. Some will justify selling your shares on the hope that the remaining shares will keep going up. They'll even use fancy computer simulations to sell the idea. And it works, right up until the time when it doesn't work, and you are selling more and more of your shares in a falling market, hoping and praying that the market goes back up. Think of 2000 through 2002 or 2008. Well, that's no plan. No wonder retirees worry so much every time the market takes a dip. They should worry. Wouldn't it be better if we had strategies that we can count on to actually produce real cash income for the rest of our lives without having to sell our shares, even when we have the inevitable market crashes and bear markets? Wouldn't you prefer that? So what is the plan? And where did Mitt Romney get over $3.6 million of income in 2011? The answer is dividends. Dividends are the cash income that profitable companies pay to their shareholders. Let's think about this. Companies are in business to make a profit. And when they make a profit, they can only do a few things with it. They can keep it to reinvest in the company to make it bigger or better, or they can pay it out to the people who own the company, the shareholders. Great companies that have a proven track record of success can pay you regular dividend payments from their profits, monthly or quarterly. And they just might grow their profits year over year, year after year. And as they grow their profits, they can raise their dividend payments. That means a shareholder can collect recurring income for retirement that could actually increase over time. Now, dividend payments are not guaranteed, but there are some companies that have long records of paying their shareholders a dividend every 3 months, and many have actually increased that dividend payment every year. And some companies have done this for 30 years or longer. Notice we aren't talking about the stock market always going up. We are talking about companies that have been in business for a long time, providing a product or service that people want. Companies that pay a portion of their profits to their shareholders as a dividend. I might be afraid to own just one or a few of these companies, but because you never know what kind of trouble a company might run into. But I really like the idea of owning a bunch of quality companies, 10 or 20 or more, each one sending me a check every 3 months. Which takes us back to Mitt Romney. Mitt's tax returns showed us over $3.6 million in ordinary and qualified dividends. Ordinary dividends are taxed as ordinary income at your highest rate, but qualified dividends are taxed at much lower rates. We'll come back to this point in a minute because it is so important. But right now, let's look at a real-life example of a company that pays dividends to its shareholders. Here's a chart of Chevron's price, charted over the last 30 years. Notice it goes up and down a lot. Sometimes it even crashes. But look at a chart of Chevron's dividend payment. Over the same time frame, the last 30 years, the dividend hasn't crashed. It has gone up and up and up some more. Isn't that amazing? Look at the gray shaded vertical bars on the graph. Those mark U.S. recessions, 1990, 2001, and the Great Recession of 2007 to 2009. Notice that the dividend didn't drop off during recessions, but still grew. Let's put the two charts together. The price has been volatile. If you had to sell your shares to collect your income, you would have been pretty nervous. A market crash could really hurt you. But if you are living on the dividend payments, well, your income has been constant and increasing almost every year. You don't have to sell in a down market. You might not sell ever. You can be very patient with volatile market prices. In fact, at some point, you might just stop even caring about volatile prices because your income is so consistent. Now, this isn't a recommendation that you buy Chevron. As an investment advisor, I can only make recommendations after I know you, your needs, and your situation pretty well. I speak of Chevron because it illustrates an important truth about investing, which is dividend income can rise even when stock prices are volatile. And besides, Chevron is just one company. We always want to diversify our client portfolios among many companies and many industries. So let's go back to Mitt Romney's tax return. Mitt had both ordinary and qualified dividends in 2011, and both make good sense for retirees. But there are big differences in how they are taxed. Now, I don't want to get lost in the weeds of taxes here, but to me, this is stunning. Dividends paid by many U.S. corporations are called qualified dividends, and they get special tax treatment. Qualified dividends are taxed at a much lower rate than ordinary income, like bank interest. Remember, in 2011, Mitt had over $2.2 million in qualified dividends. So if your regular federal tax rate on your ordinary income is 10% or 12%, then your qualified dividend tax rate is 0%. If your ordinary rate is 22%, 24, 32, or 35, then your qualified dividend rate is just 15%. That's anywhere from 7 to 20% lower than the regular tax rate. And if you're in the upper bracket of 37%, then your qualified dividend tax rate is capped at just 20%. Qualified dividends are retirement income that can be higher than bank interest. It is income that can increase each year, and it is income on which you can pay a lot less tax. And this is why I love qualified dividends. Qualified dividends received in retirement are the best. So imagine with me for just a moment. Let's think of a hypothetical. A married couple could have over $101,000 of income, yet owe no federal income tax. Notice on the tax table that married couples filing a joint return are in the 10% and 12% brackets up to $77,400 of taxable income. But at those levels, qualified dividends are not yet taxed. They are in the 0% bracket. Consider also that taxable income is computed after the standard deduction. The standard deduction for married people filing a joint return is now $24,000. That means that a married couple with $24,000 of other income, meaning maybe ordinary dividends or IRA withdrawals or pension payments or the taxable portion of Social Security, in any case, if they have $24,000 of other income and $77,400 of qualified dividends, for a total income of $101,400, they could actually owe no federal income tax. Now, Mitt had over $2 million in qualified dividends, but his tax rate on the qualified dividends was just 20%. I want you to know that qualified dividends are not just for billionaires. They can be a retirement investment. They can be a powerful retirement investment strategy for all the rest of us too. Now, nobody should put all their money in any one company or even in any one strategy. So we use at least 7 different strategies when we build our clients' retirement income portfolios. Let's look at them. First, I love a portfolio of 10 or 15 or 20 high-quality companies that have been in business for a long time with solid financial strength. We call them blue chip companies. So strategy number 1 is to own a diversified portfolio of blue chip dividend-paying stocks. I can't name any specific companies here because I'm not allowed to do that until I meet you, until we first have a conversation about you and your situation and your needs. And we can do that later. But we already talked about Chevron. There are dozens and dozens of other fine blue chip companies out there too that regularly pay dividends to their shareholders. Our strategy is to build a portfolio of these companies and direct deposit your dividend payments to your bank account. Potentially rising dividends, potentially higher than bank interest, potentially lower tax, auto-deposited to your bank account each month. As a retirement income strategy, I love it. Second, preferred stocks are a lot like our blue chip stocks. But there's a big difference.
the companies that issue preferred stocks must pay the dividend on the preferred shares before they can pay the dividend on their other shares. So in some ways they are a stock, but in other ways they're like a bond. In fact, we might call them a bit of a hybrid between the two. But the important point is this: we buy preferred stocks for their high dividend income. Real estate investment trusts, or REITs for short, pronounced REITs. REITs are companies that invest in income-producing real estate. Examples include companies that specialize in owning apartments, or self-storage units, or infrastructure buildings like warehouses. Think of all the e-commerce that happens today, and will happen in the future. Amazon has been killing most brick-and-mortar retailers. You and almost everyone you know has at one time ordered and received a package from an online purchase like Amazon. That package has passed through at least one large warehouse to get to you. Amazon, that is e-commerce, cannot operate or grow in the future without warehouses. For the most part, Amazon doesn't own these warehouses. That's not their business. But it is the business of certain real estate investment trusts that could own dozens of warehouses. Or consider computer data centers. Think of the internet. We call it the cloud. You have probably used that term before. You operate websites on the cloud, or you back up your data to the cloud. Well, the cloud is not in the sky. It is in buildings, in data processing centers around the country and around the world. It is hundreds of millions of dollars of computer equipment held and operated in buildings, in real estate, and there are REIT investments that specialize in owning that kind of real estate. Or consider healthcare properties like skilled nursing centers or assisted living centers or hospitals. The REITs don't operate the nursing home, they just own the real estate. They collect the rent. REITs enjoy a unique business structure that gets special tax treatment. Basically, if the REIT passes most of the company profit through to the shareholders as a distribution, like a dividend, then the company pays no income tax at the company level. Paying no corporate tax, REITs can pass a lot of income through to their shareholders, and that's why I like them for retirement income. Fourth, oil and gas master limited partnerships, also known as MLPs. We like MLPs for some of the same reasons we like REITs. They enjoy a special business structure that allows them to avoid tax at the business level if they pass most of the company profit through to the shareholders. So, like REITs, they offer investors a higher than usual income. This country has literally hundreds of thousands of miles of oil and gas pipelines. Pipelines that crisscross the country, delivering crude oil from the wells to the refineries, or delivering natural gas from the wells to storage facilities or to users. These pipelines, for the most part, are not owned by the oil companies. They are owned by the pipeline companies. The oil and gas producers simply pay a fee for the use of the pipeline, kind of like a toll road. Think of it. Every time it gets cold outside, your thermostat clicks on and you start burning natural gas. Every time you turn on the lights, you burn electricity that might be produced at a natural gas-powered electrical generation plant. And that natural gas arrives at its destination in a pipeline. As long as we use fossil fuels for energy, we are dependent on pipelines. That fact might reverse itself one day, but probably not in our lifetimes. And I like that our retiree clients today can collect relatively high retirement income from oil and gas pipeline companies. Fifth, business development companies, or BDCs. They're like REITs and MLPs in that they enjoy a special structure that allows them to avoid taxes at the business level if they will pass the bulk of their income through to their shareholders. Like the REITs and MLPs, this makes them attractive income producers for retirees. Business development companies are the companies that provide commercial financing to other companies. They earn their income through interest on loans that they originate and through the profits they receive on owning portions or shares of the companies they provide financing to. That was Mitt's business before he retired to politics. No surprise he has so much dividend income. Our sixth strategy is the closed-end fund, or what we call the CEF. CEFs are pooled investment funds, like mutual funds. But they are different from other mutual funds that you may have known because their shares are bought and sold in the financial markets, like a stock. This means that we can find funds that are selling at a discount. meaning the shares are selling on the market at prices below their internal net asset value. Think about this. This is a bold idea. You might get $100 worth of net asset value for less than $100, maybe $90, maybe $85. As an advisor and investor, I love this feature. Now, if the CEF is invested in high yield or high dividend securities, such as bonds or preferred stocks, then the fund can offer a higher dividend also. But if you buy the shares at a discount, then the dividend yield from the CEF can be even higher than the individual securities held within the portfolio. And that is why CEFs can be an attractive income-producing investment for the income investor. And finally, our seventh strategy is bonds. Multi-sector bond investing. Bonds are the traditional retiree income investment. Bonds represent loans or money borrowed from investors. Companies and governments of all kinds borrow capital from investors for capital expansion, for factories, for equipment, for roads, and other expansion. Bond buyers collect regular interest payments, potentially every month, from many companies and governments too. Bonds are included in portfolios as a diversification against the other things held in the portfolio, but also as an income producer. Remember, Mitt Romney showed about $3 million of bond interest on his 2011 tax return. The multi-sector bond strategy is to not buy just one bond, but to invest in many bonds, creating a broad diversification among many issuers, sectors, geography, and maturities. Bonds issued by state and local governments are called municipal bonds, and their interest is generally exempt from federal taxes and sometimes from state income tax too. So, 7 strategies. Which is right for you? Probably all of them. When we build a portfolio for a client, we often draw on all of the strategies, each one weighted differently according to how aggressive or how conservative the investor needs to be. To some degree, and in different proportions, every retiree may want to tap into all 7 strategies. Your portfolio could include blue chip companies, energy companies, telecommunications companies, healthcare, technology, real estate, bonds, and much more. We build these portfolios with 4 goals in mind. We certainly want to be diversified. Someone asked recently if this strategy is safe. Well, it might not be if you put 100% of your money in one company or stock. But if we put just a little, like maybe 1% each, into 100 different companies, then you can be more assured. We want to generate cash dividends. We want to produce monthly cash income that you can spend without ever having to sell your shares. That should come as a great comfort when the market unexpectedly takes a dip down. We want the portfolio to grow in value over time, and we want to minimize the burden of income taxes. Today's retirees live longer. They play harder. They travel. They serve. They live life to the fullest. At least that is what they want to do. If we are constantly fretting over low bank interest rates or worried about the stock market rising or falling, it is very hard to fully enjoy your retirement lifestyle. I think of my friend David. We were college buddies at BYU many years ago. Dave became an airline pilot. He had a great career and a great family. As you might guess, he traveled the world many times. But last year, Dave turned age 65. At 65, the FAA says you're through flying. You are retired. Dave arrived at that point where he could no longer produce the income he needed. He would have to begin to rely on the income that his investments could produce. So we rolled Dave's 401k into an IRA, and you already know how we invested it. Dave is invested in all 7 of the strategies. He is invested partly for growth, but largely for income. The design goal was simple. Produce enough recurring cash dividend income to supply Dave with the monthly distributions that he needs, and do it with cash dividends without having to sell any seed corn shares. Dave's dividends are swept monthly into his bank account. And I told him to just spend it. Spend it without worry. The stock market will rise and fall with good days and bad days. But it doesn't matter. What matters is that every month the cash he withdraws reproduces itself. We aren't selling shares to generate his income. We are harvesting his dividends every month. Do you think Dave is happy? I assure you he is. So could this be you too? Now your decisions are these. How will you live in your retirement years? Will you risk spending down your principal, or will you begin to invest like the billionaires? If you want to build out your retirement income portfolio, you really have two choices. You can do it yourself, or you can work with us, the retirement income specialists. For over 35 years now, we have helped our clients to prepare for and to prosper in their retirement. It's what we do. It is our passion. I invite you to schedule for yourself a free strategy session phone call with me. That phone call will take about 20 to 30 minutes. It isn't a sales call. The call is about you. We'll talk about your situation and resources. We'll talk about your desires, your goals, and your risk tolerance. And we'll discuss your needs for retirement income and how you can meet those needs. And we'll talk about your tax profile. We do this because we can't offer specific investment recommendations until we know you better. And frankly, you wouldn't want our investment recommendations until you know us better. This is your no-cost, no-obligation way to find out if we can help you to meet your needs. So it is very simple. There's a link below that you can click on. It takes you to my calendar. You choose the time slot that works best for you. We will ask you a few questions about yourself so that I can be prepared for the call. And finally, you should put the time in your own calendar, because I will call you. I promise.
This video training is a good start, but we can only really help you if we meet, even if only on the phone. So again, I invite you to jump on my scheduler and pick a time that we can talk. Thank you for tuning in, and have a great day.